Hi folks, I'm doing this video because I have seen a lot of people desperately need to have clarity on basics of investment. This is Ajay Lokesha, tuning in from my YouTube channel. I'm a passionate long-term investor. Come on, let's go ahead. These are all the contents that we are planning to cover. Definition, importance and need for investment, types of investments, associated risks and opportunities, and also the conclusion. To start with, we'll go understand the disclaimer. This video is done only for educational purpose. All financial investments may involve significant risks. Please contact your financial advisor before taking any decision on investment. Please do a thorough research on the decision which you are going to make, and please be up to date with respect to the information. What do we mean by investment? From the definition point of view, we can understand that it's an allocation of money in the expectation of more money in the future. Money can also be referred to as wealth, and future money we can also say it as returns. As we see from this picture, the small money has to become big, then only we call it as effective investment. One of the founding fathers of United States once told, an investment in knowledge pays the best interest. Isn't it so? Why do we need to do investment? Because there is inflation. We understand more about inflation in the coming slide. We need money. From birth till death, everything involves money transactions. We need to secure the future of us and also our family members for their education, marriage, tourism, and so on. We need to also prepare for our freedom so that we can do whatever we want and we can go wherever we want. Contingency also we need to be ready because we never know what may happen in the future. Just like the current situation, where there is a great lockdown and not much jobs. What do we mean by inflation then? It means it's a price rise over a period of time. We can see an understanding of an example here. In United States, between 1970 to 2019, we can see that the price of coffee for the same quantity and quality, it has increased by 6 times. That means to say the inflation, how we can understand is to buy the same stuff, we may have to spend more money later. And inflation is not so good. But what really matters for us is called as relative inflation because it impacts us. You can see in the chart here, not all things and services will have the similar inflation trajectory. You can see here, there are some services and products which are expensive, and there are some other products and services which will become affordable. Hospital services, college tuition fees, all these things are expensive over a period of time, and then wireless, telephone, electronic items, over a period of time the price reduces because of volume. Then what are the various kinds of investments that we have? Fixed deposit, gold, real estate, equity. We will understand each one in the coming slides. What do we mean by fixed deposit? We will be having certain amount of money and we keep it in the bank, and banks will take a decision what exactly they have to do with that money. They can invest or they can lend it to some other customers. But what we have to take care is not the fixed deposit rate that banks are going to give to us, but the real rate of return. Because real rate of return is the difference of fixed deposit rate and also the inflation. That means to say if inflation is higher, our real rate of return significantly reduces. From the chart you can see here, during the year 2008, though the fixed deposit rate was hovering around 5%, the real rate of return fell to almost minus 10%. So that's why for inflation, we need to prepare, and our investments need to defeat inflation rate. Repo rate, in the right hand side, we can see the Indian Central Bank, Reserve Bank of India, manages this from 8.5% to currently this repo rate is 4% from the year 2011 to now. That is June 2020. What we mean by repo rate? It means it's a repurchase rate. It's a key monetary policy of interest which the central bank lends the money to the banks for controlling credit availability, inflation, and economic growth. And then the impact of that we can see in the right hand side, where the fixed deposit rate for 7 days itself is lower than the savings rate for many of the top banks. And in the left hand chart, we can see that before 2001, the repo rate was almost 12% and right now it is 4%. And in the near future, it can even move towards 0%. So we need to be prepared for that. And the worst part is, even this return, whatever that we are going to get in the fixed deposit, is also going to be income taxed. That means to say fixed deposit is a very bad instrument for saving. And then we understand gold as an investment, which is one of the favorites for Indians. We can see in this chart with respect to gold price in USD, if you had invested just before 2011 and almost till 2019, if you want to take it out, you would not have made much money. Only in the recent past, the gold has appreciated. Gold as an investment, if you see, there are some risks associated with that, like security charges, because when there is sugar, there can be ants. So when you have a lot of physical gold in your home, it obviously attracts thieves and other negative vibes. And also, gold does not have an intrinsic value as such. It's purely dependent on demand and supply. If demand increases, the price increases. If supply increases, the price decreases. And if you want to buy the ornaments, the shops will be charging you 6 to 25%, and this charge, you are not going to get it back when you want to resell. But still, if you want to do an investment in gold, the conventional wisdom says that maximum 10% is what you can go ahead. Then we come to real estate. Why we do real estate investments? Because of the land price appreciation, or if we construct a house for rental income, we do that. But there are a lot of risks that are associated with respect to the real estate investment. Biggest one is illiquid. Means once you have got it, once you have bought it, it's very difficult for you to sell because nobody will be ready to buy when you want to sell. And also it is high value item, a lot of taxes, a lot of regulatory requirements. There can be a lot of frauds. That means is that the plot which you want to buy, you never know, it might have been already sold to somebody else. So you might be a duplicated party. Huge risk. Other risks are like maintenance. Because of environment condition or tenant behavior, you may have to do rework, repair of your house. If you've got a plot that is very far, you need to spend a lot of energy and resources to monitor that from time to time. And recently we got regulatory clearances from the parliament called as RERA, demonetization, all those things. And also there is a mega trend that is going on, remote work, which can have significant negative impact for the real estate investment. Then what is left with? Equity. You can see from this chart here, from its time of inception till now, there is a huge increase. Of course, there are ups and downs, but When there is that kind of a reward, little amount of risks will be there. If you would have invested 1 lakh in this index itself, it would have made you 1 crore and 70 lakhs. That means to say it's a staggering 170 times. That is approximately 17% compounded annual growth rate. That too in the index. But if you specially select some companies like Bajaj Finance or Infosys, it would have been a much different story. Infosys at IPO, if you had invested, one share was costing 145 rupees. So 100 shares would have costed you 14,500 rupees. It would have made 1 crore. Bajaj Finance, if you had invested in the year 2009, just 10,000 rupees, it would have made 83 lakhs. That's huge. It's 830 times. But equity, when we are doing an investment, we need to be careful with respect to diversification. Means we can't put all the eggs in the same basket because we never know what's going to happen to that. We need to select for right businesses, integrity management, moat. Moat means to say a company, if it is having a very strong moat, that means to say for the competition, it's going to be a tough life. You need to also see the intrinsic value, fair value of that investment before you purchase. And also you have to get into those kind of companies which are having low debt or no debt. If you can't do at an individual level, you can always go and take support of mutual fund managers. They will charge you certain basic amount, but it's okay. There are certain risks that are associated with equity. We can lose the complete capital if our company selection is wrong or timing is wrong. Some investments really can bother you with respect to the time. You need to be having a lot of patience for this investment because sometimes market takes a lot of time to understand and give right value for that investment. Knowledge on micro macro factors are also important. Micro refers to company like profit, turnover, debt level, management integrity, return on equity, return on assets, return on capital employed. All those things you need to be aware. If you want to concentrate on the macro factors like global political scenarios, trade wars, disruption, dollar price, oil price fluctuation, conventional, unconventional wars, or at the national issues like elections, inflation, fixed deposit, GDP growth, budgets, all the knowledge you need to have because these external and internal issues can matter your investment. The last area is equity can be of various types: micro, small, mid, large. Micro and small cap will come with high risk. You need to be careful. Where the super rich of India invests, in a cumulative level, 29% investment are going towards real estate, 19% for gold, 17% for stock, and 9% for fixed income. That's the difference between rich and the poor, because poor concentrate their investment more on the bottom, that is the fixed income, which is not that efficient, and rich concentrate in the other side of the spectrum, which is far more efficient. That's the story so far. Now, if you want to understand the real returns, then we have to compare that with the inflation rate. In the long term, if you see fixed deposit, if you are lucky, can cross 1% above inflation. Gold can cross 2%, real estate can cross 3%, and stock market can cross 7% above inflation. That's very good. That means to say stock market is having an advantage, and we need to leverage that. And super rich also may change their allocation based on this trend. At the global level, if you want to compare various major countries like leader United States, you can see here almost 25% of entire globe's GDP is being concentrated at United States itself. And more than half of the market cap of entire world is with United States, with a population of just 4%. where is India? Contribution of just 3% GDP of the global GDP, and then population of 18%, it's almost 6 times the GDP, and then the market cap is just 1%. That means to say there is a huge scope of increase in market capital considering our population and growth trajectory. What do we need to do then for the investment? We need to see the risk versus reward. We need to see the central tendency and also the variance. Stock market is definitely good from the central tendency point of view, but it comes with a cost. That is the variance. Means there will be ups and downs and we need to have gut to withstand that. Mark Zuckerberg, Facebook founder, once told, the real risk is doing nothing. How true is this? Before investing, we need to take certain steps. We need to keep it clean. We need to get rid of the debt, whatever that we have. And we need to spend less. It's always good. Earn more. Invest wisely. It's so simple. Saved money, invested money will always save you. Save us. Save everybody. That's all I wanted to say. Thank you so much for watching. Please do subscribe and share to as many people as possible, because you never know how many people will get help from this. See you in the next video.